Hello there, welcome to Trading Day. Let's get to the big stories we're bringing you from the BNN Bloomberg newsroom. Energy Minister Tim Hodgson says the federal government is willing to negotiate with other provinces on lifting clean electricity rules if they have similar policies. Prime Minister Mark Carney suspended the rules for Alberta after signing a deal to move towards creating a new pipeline to the BC coast on the condition that the province adopt a stronger industrial carbon pricing regime. Shares in Transat up about 5%. The airline and tour operator confirmed receipt for a request of a special shareholders meeting from Pierre Palladot of Quebecor fame. The company says that multiple directors have met Palladot to explore options for the company's future. Transat says the board has a clear and disciplined plan for the company. Palladot's firm is calling for changes to Transat's board. There have been calls for restructuring the company and for initiation of a review of strategic alternatives. Allied Properties REIT cutting its monthly distribution to unit holders by 60%. The Toronto-based office space developer says it has cut its debt in the last 2 years with the sale of non-core assets, a process that will continue into 2026. The debts were in part from completing the last of its development projects. And the TSX slipping from Friday's record close. Let's have a look at U.S. markets. They have seen some selling today. Apparently, some investors disconcerted by a plunge in cryptocurrencies. We've seen Bitcoin, for example, sliding once again this morning. It's going to be a big week with the banks reporting earnings, always an important event for Canadian investors. And of course, we're into the last month of the year, usually a great time for stocks. Let's get more from Kevin Hedlund, Co-Chief Strategist at Manulife. Thanks very much indeed for joining us this morning, Kevin. Just remind us, I mean, December, usually pretty reliably a good month.
December is usually reliably one of the best months for the TSX and SP 500. Often we talk about a Santa Claus rally. Perhaps investors are a little exuberant and happy with the holiday season, and perhaps that helps move markets higher.
The bank earnings are coming out this week. What are you looking for here? What areas of weakness do you think might emerge in the banks?
We're actually very positive on the banks on this quarterly earnings announcements. Fundamentals remain very strong. When you look at the rates market, it has come down, which perhaps has facilitated some of the risk in the mortgage market. But when you go back to mortgages that were originated in 2020 and 21, the stress test rates were actually higher than the current 5-year fixed rate. So that perhaps has alleviated some of the stress there. We think loan loss provisions are perhaps going to come down once again, given the underlying economic fundamentals remain sound in Canada. So ultimately, it's not a phenomenal environment, but still very solid. And I think the banks will once again continue to announce very solid earnings, especially those that perhaps are related to capital markets. As the markets have been moving higher, of course, there perhaps is more trading, more activity in those markets, and then it helps support those lines of businesses for those banks.
The Canadian Bank Index, maybe we can put up a 5 or a 10-year chart, hit a record high on Friday. Do you think there's too much optimism about the banks? I mean, the economy is going through a soft patch. Growth isn't much more than 1%, for example.
Correct. We see below trend economic growth. The good news perhaps is at the current environment, we are avoiding the dreaded R-word recession. But yes, the economy is still in a sluggish patch. There still are some risks there. Ultimately, the banks have driven higher. Perhaps they were undervalued coming into this year. They have been one of the main drivers of TSX performance, along with gold and certain companies. There probably is still some sustainability for the banks moving forward. Perhaps not to the same extent we've seen, but we don't see any trouble on the near-term horizon and necessarily for current stock prices on it for the banks.
What is your broad outlook for the Canadian markets this month as we close out 2025?
Yeah, we're still very optimistic. We could still, hit new record highs for the Canadian equity market, the TSX. There still, again, is some pretty good solid fundamentals there. Companies remain, in good shape. There are, as you said, economic weakness in certain areas of the market, something to pay attention to. But overall, I think we are still optimistic and constructive on TSX into this year and even to next year. Again, perhaps not the same rate of change and growth that we've seen in 2025, but in the near term, there doesn't seem to be any alarming issues that we should be avoiding the TSX on a whole. I would say that perhaps in this marketplace where you see valuation that has moved higher and perhaps the drivers of returns have been concentrated in certain sectors and certain companies, that is really points to an opportunity for active management to find perhaps dislocations in quality companies that perhaps are under-owned or under-loved at this point in the cycle.
Are you seeing some sectors, for example, unfairly neglected by investors?
The TSX, of course, the sectors are so heterogeneous. It's hard to say which sectors we like. But definitely there are some companies that are attractive here. We don't want to be necessarily overweighting Canada on a geographic footprint, but there remain some solid opportunities there. And our portfolio managers that are focused on Canadian equities are still finding some great opportunities that the market perhaps hasn't moved or shown some positivity to just as much as we would expect just yet.
What about bonds? Your balanced portfolio managers, are they overweighting or underweighting bonds?
We're actually currently underweight fixed income when you look at a 60-40 strategy, but not perhaps underweight as you might expect. There really is no reason to increase fixed income to a perhaps above neutral weight. When I say underweight, I'm saying very barely underweight. A 60-40 portfolio is perhaps 65-35. There's still some attractives in equities, but you still want to pay attention to bonds. I think it's important for those investors who have shied away from fixed income in their portfolios over the last couple of years because equities have done so well. This is a great time to review your portfolio coming into 2026, understand how much risk you want to be taking. And sometimes when equities run, you actually are taking more unintended risk than you expect to. And as I've said many times with advisors across Canada, most clients don't, or probably no clients have, 15, 20% target rates of return in their financial plans. It's important to understand risk reward at this point in the cycle.
Kevin, thank you very much indeed.
Thank you.
Kevin Hedlund, co-chief strategist at Manulife. Coming up, Barrick Mining exploring a possible initial public offering of its vital North American gold assets. We'll have more after this. Barrick Mining shares trading higher today. That's after the gold giant announced that it's exploring an initial public offering of its North American assets. We are joined for more by BNN Bloomberg's Lindsay Biscaya. Lindsay.
Yeah, and a lot of analysts, Andy, Bloomberg analysts in particular, are saying that these assets could be worth more than $60 billion, like around $62 billion. So this would be a big deal. As you mentioned, the company's board members have now approved management to kind of look into this idea of an IPO, selling off a small minority interest of its North American gold assets. You can see Barrick Mining doing not too bad today. It was up about 2% earlier today. It's down a little now. But if this were to go ahead, the subsidiary called Newco would hold its big gold mines in Nevada and Dominican Republic, and then Barrick would retain a majority interest in this spinoff. But this would basically be a pure gold company because right now Barrick has mostly gold mines in North America, but it does operate some copper mines overseas, mostly in Africa. So a pretty interesting addition here to a company that's really made headlines for a couple of weeks now. We also spoke to Colin Shazinski of Wealth Management earlier today, talking about why this would be so significant and what he thinks about this idea of an IPO. Take a listen.
What it seems like they're trying to do is to kind of unlock some of the value in the North American operations, and then here's what they're going to do with it. Right after that, are they going to use that to potentially shore up some of their international operations? It kind of remains to be seen at this point in time what they would do with the capital they raised from this spinoff.
Because you hear Shizinski talking about unlocking that value of the North American assets. Right now, a lot of analysts are saying they feel those North American assets are undervalued. So management exploring this measure for the first part of 2026, expected to come back with an update in February. And then, of course, if the idea is to, have this IPO, then the board would have to, of course, vote on it.
Yeah, I see the stock up a little. As you noted, was up more. I've seen one price target raised to 47 US from 39 at UBS. Yeah. So certainly this is going to raise speculation. Are these North American assets undervalued?
Well, that's just it.
Yeah.
A lot of people looking into that, as you mentioned, a lot of buy ratings, a lot of outperform ratings. So most analysts see positive, like a positive kind of outcome coming from this idea. It was interesting that we got a statement from Jefferies analysis on this idea just last hour, saying this does not sound the same to them as breaking up into two separate entities. There's been a lot of talk about Barrick Mining potentially breaking up into two separate entities, right? Having the North American side and then the South Asia, Africa side of things. They don't see that as a breakup. Jefferies is saying they see this as more as a measured portfolio changes to come. So more to come. They see Barrick Mining potentially selling off some of its mines in Africa and potentially selling off that big mine in Pakistan, the Reko Diq mine, selling off. Right now, Barrick owns about 50% of that. And Jefferies sees them selling down more than 50% on that mine. But then TD Cowen also saying they see substantial upside here, noting that the North American assets alone are worth almost as much as the whole company together. So yeah, mixed reviews at this point.
Lindsay, thanks very much.
Thanks.
Lindsay Biscaya. Right, so our guest says Barrick is considering spinning off a minority stake in its North American assets, just a minority stake, because it doesn't want to give away the crown jewels. We're joined by John Ing, CEO of Maison Placement Canada. John, thanks very much for joining us. Kind of interesting, isn't it? Yeah, they're not talking about a breakup of the company, as Lindsay just pointed out. So it's kind of putting a toe in the water, it sounds like, this IPO.
Well, Andy, I think it's the parts are worth more than the whole. When you look at the Nevada joint venture, that's probably one of the world's richest mining complexes in the gold mining business. An interesting piece of Barrick is the 4 Mile, which is a potential huge tier 1 asset. You're looking potentially at 25 million ounces in the ground, very rich at 15 grams per ton, a potential producer, maybe 750,000 ounces every year for the next 9-10 years. So it's a big potential mine. And I think that in the key part of it is outside the Nevada joint venture right now. There's a feasibility study expected sometime in the early part of 2026. That will bring a valuation, and I think that right now it's part of the plan of being in this new IPO. So there's a lot of value in addition to the mines that are in Nevada. There is this 4 Mile potential pickup. So the parts are worth more than the whole in this day.
And it's interesting. I mean, this would reverse, or it looks like they could end up reverse if there is a breakup. It would end up reversing that merger between Barrick and Randgold, in which Mark Bristow took over as CEO.
Well, I don't know whether it's reversing that. It brought the Randgold brought a lot of cash flow, which when Barrick, if you recall, had a stretched balance sheet. Now with the gold prices, with the moves by Bristow and Fuller, there's no question that the balance sheet is super strong now, and it's a good part. It's a good time to be in the mining business. Barrick has the largest array of tier 1 assets, and dividing into, to me, didn't make sense. This makes a lot of sense. It surfaces value in Nevada joint venture. I should mention that for a long time, Barrick has traded at a discount to its peers. It's traded at 0.85 times. When you look at some of the North American, Eagle, 1.1 times. So there was a discount. And so spinning this off, may be a way to close that discount.
Right. Yeah, it was 2019 they actually did that merger. So it would be a kind of odd situation, wouldn't it be, though? Barrick would presumably at this stage stay a listed company, and then they'd have this new co trading separately, owning some of the North American assets.
Well, that's right. I mean, it's often in a lot of businesses, they own subsidiaries. Cash flow is going to be very important. So they're not going to spin off the very profitable mines. I mean, yeah, in the 9 months of the free cash flow was something at $2.5 billion. And the Nevada joint venture is about half of Barrick's assets. So it's a surfacing of value. They want to keep the cash flow too, but they're going to share with the public, and the public will, interesting enough, will give it a valuation and likely close that valuation gap.
Is this putting a for sale sign on these North American assets, in that analysts are saying, well, Newmont is going to be very interested, come sniffing around, try to acquire the stuff. Some of that, the Nevada stuff, a lot of it's held in a joint venture with Newmont.
Well, the Nevada joint venture, Barrick owns 68.5% of that. Newmont owns 38.5%. Newmont's dilemma, if they want more of the Nevada joint venture, then they are going to have to go after Barrick. And while that's a possibility, I think Newmont has learned that just acquiring assets is not exactly the way to go. They've had two very big assets and have taken two very big write-downs over the pieces. So when I look at the assets of Barrick, and I've been saying for some time that it is undervalued because those tier one assets are long life cash cows. And that's what you want in the gold mining business.
Yeah. It would be interesting. I mean, Barrick, they're officially the head office is in Toronto, but it's been cut back radically, hasn't it, John, over the years, the actual presence in this city?
Well, it's interesting. Well, Barrick's a Canadian mine, and their head office is in Toronto. They no longer have a Canadian mine. They just sold Hemlo, for example. I think that was wrong. That was a mistake. I think that, but I think management, Bristow, they have a lot of mines. It's hard to manage different parts of the world. You mentioned Pakistan. They're bringing in foreign strategic sovereign partners to defray the risk. Because there's no question that today jurisdictional risk is a big factor. So this is a way for Barrick to surface the value of North America.
Yeah, and that Pakistan mine, it's right on the border there with Afghanistan. It can be a troubled part of the world.
But the great thing about mining, and particularly gold, there's a lot of gold there. So we have found, and I note that Barrick resolved its problems in Mali, just as they did in Tanzania. Gold mining is a tough business, but it presents a lot of cash. And given today's gold price and my expectation that the gold price is going to go higher, Andy, this could be very profitable.
Yeah, the industry is just minting money right now, isn't it, John, with this gold price?
Well, particularly the Canadian producers, when you look at somebody like a Eagle, when the gold price is at $4,200, so $6,000 Canadian, your all-in costs are $1,500, $1,600. So that's the profit margins are huge. The only problem, Andy, as we know, is that we're not finding enough gold mines. And gold has become a critical metal strategically from sovereign nations. And so reserves are declining for a lot of these producers. That's why when you look at Barrick, when you bring on something like 4 Mile, which is, as I mentioned, the feasibility study will next year, it might cost $1.8 billion to put into production. That's going to be a very profitable mine.
John, thank you very much indeed.
Good to be here.
John Ing, CEO of Maison Placement in Canada. Coming up, hot picks. We checked out 2 stocks in apparel and 1 in toys. We'll be right back. On Hot Picks earlier, we checked out 3 consumer-focused stocks, 2 in the apparel business. We were joined by Zachary Waring, equity research analyst at CFRA. We start off with his first idea. It is a shoe company called On Holdings.
A fast-growing footwear company, and they're also moving into apparel. We think the move into apparel will help growth over the next 3 to 5 years. But their footwear business is one of the hottest brands in the world right now. And we think shares are undervalued. You know, they've fallen because of the tariff talk. They do most of their businesses in the U.S. right now. They do have a Europe business and an Asian business, but the largest part of their business is in the U.S. So they've been impacted pretty significantly from tariffs and the tariff talk in the U.S. However, in their last quarter, you know, they actually saw gross margins increase pretty significantly too. So it kind of just shows their pricing power. And we really like the name. We think, you know, shares trade around 25 times forward earnings, and that's well below their 3-year average. We think this is an opportunity.
And what is distinctive about their clothing?
So their footwear, it's a newer brand. They're just doing a really good job in innovation. But I think in general, they're a really hot brand. People love the product that they're putting out. They look very clean and aesthetically pleasing. So, you know, we think they're in the same ballpark as Nike in terms of innovation. They're doing a really good job there. But we just think shares are pretty much really undervalued here.
What about Abercrombie and Fitch? They have been in vogue lately.
Yeah, so, you know, Abercrombie obviously had a really big pop after earnings. You know, shares were up 40% that day. That's continued over the next couple of trading days as well. And we still think there's plenty of value in shares. So, you know, shares trade under 10 times forward earnings still. This is well below their 3-year average. Once again, this is another company that's been significantly impacted from, you know, the tariff. I think investors are really sitting and waiting to see what the actual impact of these tariffs are going to be over, you know, a full year period. And you're just starting to get, you know, some of the impacts. So they are seeing an impact, but they've been able to offset, you know, a pretty good portion of the tariff impact. And I think, you know, from a value standpoint, you know, they trade under 10 times. I think their 3-year average is around 15 as well. So, you know, there's significant value, I think, emerging in these shares.
And then finally, Hasbro, they do sell clothing linked to their toys, but it's not a big part of their business. What is attracting you to Hasbro these days?
Yeah, so the reason we really like Hasbro is their digital business. So obviously, most people know Hasbro from their consumer products division. So they sell a lot of toys. They're a toy manufacturer. But over the last, you know, 3 to 5 years, they've grown their digital business significantly. And it carries a much higher operating margin, 40% plus operating margin. So as that business has grown and become a bigger portion of total revenues, you've really seen their operating margins improve. And it makes them a little bit more insulated from some of the tariff talk and some of these tariffs that the new administration has put in. So, you know, valuation is fair here. I think they trade about 16 times forward earnings, which is above their 3-year average. But before, you know, 2019 and before, the company traded above 20 times forward earnings. So we think there's an opportunity here as investors kind of catch on to the margin story.
And sorry, what is their big source of profits, though, these days? Where would most of their earnings come from?
It's digital. So their digital business is driving, you know, most of their profits right now, especially as their consumer products division or their toy division has faltered. And you've seen, you know, big decline in their consumer products division over the last 3 years since COVID. You know, the COVID highs, as you came out of COVID, they did really well. But since, you know, you've seen a big decline. And we think as you turn the corner of the tariffs here in the next year, in the second half of next year, you're going to start to see not only margins improve for their consumer products division and aid the digital products division, you know, we think the revenues will also turn around.
That's Zachary Waring, an equity analyst at CFRA. Coming up, we're going to look at this sell-off in the crypto space with Bitcoin dropping below $85,000 US. We'll be right back. Big news in mining. Barrick says it's exploring an initial public offering of its North American gold assets. If that goes ahead, the spin-off would be anchored by Barrick's mines in Nevada, but would also include its giant asset in the Dominican Republic. Barrick, though, would retain a majority interest in the new entity. This comes amid reports the company is being pressured by investors for a shakeup. Shares in Shopify are falling today, down about 5%. Oppenheimer's Ken Wong says the $6 billion in merchant sales that the company posted during the Black Friday promotional period was below analyst expectations. Now, the analyst also said that the pace of spending at the e-commerce firm moderated through Sunday. Shopify also posted that some merchants are currently experiencing issues accessing their accounts. Bausch Health is one of the best performing stocks in Toronto today. The pharma company said it has acquired a long-time Chinese distribution partner called the Shibo Group. Bausch says the move is aimed at meeting rising demand in China for its aesthetics skincare business. Terms of the deal were not disclosed. And the TSX, which did hit that record high on Friday, under a little bit of pressure. Right now, nothing drastic, down 0.5% as markets get back to normal after last week's Thanksgiving holiday south of the border. Big traders in Toronto right now, there's the US market. Big traders in Toronto, Suncor down, Royal Bank down, Celestica down more than $20. And there's a quick look at the US markets. They too are under pressure. Bitcoin slipping at one point today below $85,000. It looked like this sell-off that's afflicted the cryptos at one point last week seemed to have eased, but it's back on. We're joined by Alexandra Bloom, founder and CEO of 2Prime. Alexandra, thanks very much for coming on the show. What do you think has been causing this weakness in cryptos?
Andy, great to be back with you. I would say a couple of things. First of all, this is just the life of a Bitcoiner. I think if you zoom out a little bit over the last years of Bitcoin, there have been 21 pullbacks of 30% or greater. And I was counting in my career, I think I've seen 14 of those pullbacks. And so in one sense, it's just normal behavior of an asset that has natural supply and demand dynamics. At the same time, there are crypto-specific things. There's big liquidations in October that I think the market is still recovering from. And on top of that, we saw the Bank of Japan. It looks like they're going to increase interest rates, which was a bit unexpected. And liquidity conditions broadly have been sort of tight. But at the same time, I can tell you, our firm does Bitcoin-backed loans, and we're doing several $100 million of loans just this week. And we're working with clients that are large operating businesses that have Bitcoin, hundreds of millions on their balance sheet. And I don't see any of them pulling back or looking to sell. In fact, they're looking for ways to generate more return on that Bitcoin. And I think they see this pullback as a time to either acquire more Bitcoin or to be more aggressive in finding other ways to monetize the asset. And so, I think we've seen an institutionalization of the asset class over the last few years, especially since the ETF was introduced. And as a result, you have more counter-cyclical behavior where, 30% drawdown is not unusual, but there's companies that are looking to buy around these prices.
So you just remind us, you do Bitcoin loans. How does that work? You lend money to people who own Bitcoin and the security is the cryptocurrencies?
Correct. We're one of the largest Bitcoin-backed lenders in the world. We've done about $3 billion of loan volume over the last 2.5 years. Business started 7 years ago, but lending about 2.5 years ago. And that's correct. People send in over-collateralized excess Bitcoin, and we'll lend a portion of it as dollars to the client, and then that Bitcoin secures the loan. I think market-wide, last cycle, it got up to about 60 billion of total loans, and I think we're somewhere in that range currently as well. However, Bitcoin's twice the price it was when those other peaks were reached last cycle.
And how do you guys raise the money to lend? How do you finance yourselves?
Sure. We work with a network of capital partners, including banks and family offices and private businesses that are looking for a return in excess of treasuries that is actually a very low risk kind of loan with how over collateralized they are. And so we lend to some of the largest Bitcoin miners in the world. We lend to funds, family offices, prime brokers, and other groups in the space that have large amounts of Bitcoin, and we manage that collateral and earn an interest rate.
Tell us, for people who don't spend all day in Bitcoin or in crypto like you do, what's happening in the market that we haven't heard about? What's a big under the surface trend in crypto right now?
Well, I think the biggest thing is I see in the background, we're speaking with new clients that are regular businesses, that are public companies that are onboarding Bitcoin and looking for ways to use their balance sheet in more intelligent ways. Some groups have just bought Bitcoin, but there are real operating businesses that are looking for ways to put it to work, either through loans or they hire us to generate a return on that Bitcoin in a low risk way. And so I think you'd be amazed at the names of the companies and the number of companies that are coming online over the next couple months, Q1 and Q2 of next year. I know we're onboarding several 11-figure businesses that have Bitcoin on their balance sheet. Beyond that, I think there's a wave of, like Charles Schwab, for example, is bringing Bitcoin to retail investors early part of next year. We're looking at, JP Morgan just announced a structured node. And so there's a huge broad swath of new products coming that I think will continue inflows into the into Bitcoin.
That's interesting. Charles Schwab, right now they're not offering clients Bitcoin?
Not retail clients cannot buy or sell Bitcoin in their accounts, but they say they're introducing this in the early part of next year, which is, trillions of new assets available to buy Bitcoin.
Oh, for sure. But the ETFs, I guess they've been out now for more than a year, but they transformed the crypto space, as far as I can see, made it much easier for people to kind of put a toe in the water and then without opening an actual crypto account.
That's right. One, just by BlackRock creating a Bitcoin related product, it kind of gives cover to every asset manager to offer this without it being an embarrassing or shunned kind of asset. It really brought it into the mainstream. And then the ease of access to an ETF, simpler custody, regular financial rails has allowed a lot of new participants to enter. And I only can expect that to continue. I just saw, I think last week, that the Bitcoin ETF has become BlackRock's most profitable ETF product in their entire business. So I'm sure they're motivated to keep it growing.
Right. Thank you, Alexander. Always great hearing from you.
Good to speak with you again.
Alexander Bloom, founder and CEO at 2Prime, the big Bitcoin-based lender. Oil prices holding their own today. OPEC Plus sticking to that strategy of maintaining production levels during the first quarter, not raising production officially anyway, amid concerns about a supply glut. That's ahead. For now, officially, OPEC Plus is sticking with a plan to pause production increases during the first quarter of 2026 amid signs of a surplus in the global crude market. Let's get more from Gregory Brew. He's written 2 books on the history of modern Iran. He's a senior analyst at Eurasia Group. He's been around the oil market for quite a while. Gregory, it's great to see you. So I know this is simplistic, but basically OPEC Plus, they're interested in increasing production to maintain market share, but they don't want to flood the market.
That's absolutely right, Andrew. OPEC Plus's strategy since April has been to increase production, to retake market share while slowly easing off the market management that it's been pursuing for the last several years. But lately, I think the members of OPEC Plus have grown a little wary of how much additional supply to bring on. They're conscious of adding supply too quickly. They don't want to push the market into oversupply. They're watching the nature of the supply-demand balance very closely. They're watching the forward curve, which remains in backwardation, suggesting there's additional space for more supply, hasn't yet flipped into contango. They're conscious of balancing supply with things like geopolitical risk, the ongoing Ukrainian attacks against Russia, a member of OPEC+. That's putting upward pressure on prices. So for now, there appears to be space for OPEC Plus to continue with increasing production. But for the first few months of 2026, they want to press pause. They want to see how the market's looking in the latter part of the year.
You, Gregory, I got to get your take on this. You just wrote an article in foreignpolicy.com, and the headline is Why Oil Sanctions No Longer Work. Can we switch over to that? So America talks about these, the Americans in particular, sanctions on Iran and Russia, but are they a blunted tool now?
Well, Andrew, it's a very interesting question. On one level, sanctions do work as a tool for shaping markets. Iran is a great example. The U.S. has had oil sanctions on Iran since 2018. And as a result, Iran can only sell to one customer, China. Now, they've had a lot of success. In the last few months, Iran's oil exports have been moving above 2 million barrels a day. And that's the highest level of exports since sanctions were reimposed. But Iran remains constrained. Sanctions have forced them into this narrow channel. At the same time, sanctions are supposed to work as a tool for changing state behavior. The whole reason behind sanctioning Iran's oil exports is to convince Iran from ending its support for regional proxies like Hezbollah in Lebanon, to back away from its nuclear program, to stop developing ballistic missiles. Iran hasn't done any of those things. If anything, it's doubling down in the wake of the war with Israel that it fought in June. Flipping over to Russia, the U.S. and the EU have been putting increasing sanctions on Russia since the invasion of Ukraine in 2022. Just a few weeks ago, we had the U.S., sanctioning Lukoil and Rosneft. But again, the goal is to try to change state behavior. And nothing that I've seen from Putin suggests that he's going to pull back on his war in Ukraine. So in that sense, yes, the sanctions no longer work as they originally intended.
Where, if you had to, it's very hard to measure. The world burns 100 million barrels of oil every single day. But is it your read that a serious surplus is emerging in the crude market globally?
I think there is going to be a surplus. It's really just a question of how big and whether geopolitical factors push the market in the other direction. In a way, the fact that, so many analysts, so many models are predicting a pretty significant surplus in the early part of next year, that's part of the reason why we're starting to see increasing geopolitical pressure. The U.S. sanctioning Lukoil and Rosneft, Ukraine attacking Russian export terminals in the Black Sea, and then apparently a couple of tankers over the weekend. There were reports that at least 3 tankers linked to Russia's oil trade were struck by missiles or drones. This all stems from the fact that there is likely to be at least 1.5, perhaps even 2 million barrels a day of excess supply in the first half of next year. And that suggests that the market is soft enough to absorb additional geopolitical risks, to absorb additional supply shocks. So in a curious way, the imbalance in the fundamentals suggests that we have greater risk of geopolitical events with Russia, with Venezuela, right? There's increasing signs the U.S. might be taking action against Venezuela and potentially against Iran as well, right? The issue there around Iran's nuclear program hasn't been fully resolved. So while I'm conscious of the fundamentals pushing the market into oversupply and pulling prices down, I would encourage everyone to remain conscious of the geopolitical factors.
Yeah, Venezuela, it's kind of bizarre. America has been buying oil from Venezuela for years. And is it plausible that President Trump would actually launch military action against that country?
Well, Andrew, I'm always conscious of predicting exactly what President Trump is going to do. Okay. He is unpredictable. He's proven himself that. I would say that the U.S. is marshaling a huge number of military assets in the Caribbean. It's really historic. There's an aircraft carrier. There's at least 10 surface vessels. There are fighter squadrons. There have been attacks against these boats allegedly moving narcotics out of Venezuela over the last several weeks. The president is being somewhat cagey in his rhetoric, right? There was a call between President Trump and President Maduro of Venezuela about a week ago. But the signs all suggest that the U.S. is preparing to escalate against Venezuela. Whether it affects oil, that's something of an open question, right? To your point, Chevron remains active in Venezuela. The U.S. continues to take some Venezuelan crude, although something like 85% of Venezuela's crude exports go to China. Again, like Iran, it's constrained by U.S. sanctions. I think the U.S. has an interest, if it does escalate against Venezuela, in avoiding striking any energy infrastructure. Let's say that there isn't a campaign against Maduro and it is successful, that there's some kind of government change or some kind of regime change. A new government in Venezuela is going to need oil more than ever. And if the government is supportive or friendly towards the United States, that means that the U.S. has an interest in preserving Venezuela's oil and export infrastructure. So I don't think the U.S. is likely to strike that infrastructure if it does in fact escalate against Maduro. But again, we'll have to see what President Trump decides to do in the next several weeks.
Gregory, thank you very much indeed. Gregory Bruce, senior analyst at the Eurasia Group. Okay, coming up next, Cyber Monday in full swing, although apparently Shopify not knocking it out of the park this year. We're going to hear more, though, about the trends after this. And just a reminder that Know Your Options is back. Tune in Wednesdays at 3 p.m. Eastern to get all of your options trading questions answered by Chris Tom of Moat Financial. Send your questions in now. Know Your Options at bnnbloomberg.ca. And that's this Wednesday at 3 p.m. Eastern. Cyber Monday is in full swing. There's been a prediction from Salesforce that the sales growth this year is likely to be slower in the US than in other regions, notably Europe. Let's get more from Bloomberg's Spencer Soper. Spencer, thanks very much. So it's not a blowout in the States in terms of sales growth. It's up, but it's not a huge Cyber Monday?
Yeah, Cyber Monday is expected again to be the biggest online spending day of the year, but that's been, it's like every year they set a new record, so that alone isn't much of a big deal. But this finding that U.S. sales growth, online sales growth on Cyber Monday is lagging the rest of the world, particularly Europe, is surprising and is a new phenomenon. It largely reflects this is our first Cyber Monday since Trump has imposed these sweeping tariffs across the globe. And then you also have in Europe, you've had a succession of interest rate reductions starting last year. So you're seeing the European economy get a little bit of a boost while the U.S. might be suffering a bit under the tariffs and also the government shutdown we had just a month ago.
It's interesting. Global online spending, mostly from Europe, will hit almost 54 billion, whereas U.S. spending will be about 13 billion, according to the estimate. It's interesting how much smaller U.S. spending is. I know it's the rest of the world, but you'd think America would be bigger, relatively speaking.
Yeah, well, a big thing there is not so much the overall amount, but just the growth rate, and that the global growth rate is about double what the U.S. is going to be. So we're definitely seeing some muted effects here in the U.S. according to that forecast.
And sorry, you may have mentioned this, but the de minimis exemptions where people can't bring in small packages free, did that ever kick in? I lost track of that.
Yeah, so those ended. Those are no longer the law of the land. That was largely what gave rise to sites like Temu and Shein, where people could bring in anything if it was under $800 in value, it would come in tariff free, and that ended this year. So that's no longer a factor.
There are some big discounts, though, according to Salesforce. In some cases, in America, averaging 31% compared to 28% last year.
Yeah, so there's always this kind of standoff between retailers and consumers, and retailers, want to get you to compel you to shop earlier in the season just so that they smooth things out. Yeah. And shoppers are conditioned to think that they're going to get the best discounts on Cyber Monday, and that indeed happened this year with the best discounts so far, even compared to Black Friday.
I'm like that with the Christmas candies. I wait and they mark them down, but of course it's a complex dance of death where I'm doing with other bargain hunters as well. Sometimes I end up with empty shelves. Just very quickly, Spencer, sorry, we've only got about a minute. Are there any particularly hot product categories this year?
Well, one thing that Adobe said they're seeing is people are spending on their homes again. If you remember, we had the pandemic when everyone was stuck at home during lockdowns, and a lot of people spent big on freshening up their houses and everything. That was about 5 years ago. Yes. And so now that we're pulling out of that, people are again spending a little bit on their homes, kitchen things and home decor. Those sort of categories are doing well.
Thank you very much. Really appreciate it. Spencer Soper of Bloomberg. We're out of time on trading day. Thank you very much for watching.